Good evening, everybody. Wow, that was the fastest. Some evenings I give prizes for the very first person to say hello or good, or not for tonight though, but especially with that fast response. It was very impressive. Tonight was a kind of not even an event. I'm calling it, as you can see there, just a talk session. And I decided to do it last minute for two reasons. Number one, I'm going to teach something that I think is one of the most important concepts you can learn. I'll discuss why I'm going to teach in just a minute. And I also, like I always say, I don't want to ever overpromise. So we're going to spend 10 or 15 minutes on that. And the other benefit to me was I wanted to discuss and answer questions about the DTS long-term trader. I put a couple of emails out recently about it, got a lot of questions about it, which implies to me that I'm not a good communicator. Maybe I am, maybe I'm not. But some people wanted to get together and talk about it. I talked with a couple people and I said, hey, anybody who's interested, hang around after 15 minutes. So 15 minutes will be a great topic. And then after that, if you're not interested in the long-term trader, just get the heck out of here. And if you're interested, you can ask questions and I'll explain in great detail exactly what it's about. It appears a lot of people are confused. So let's get going. Long-term discussion management, 30 minutes on a key topic. Actually, it's 15 minutes on a key topic. Feel free anywhere along the way to ask any questions that you want to do. I like shotguns over BB guns. I've said that phrase. I think I even did a whole presentation about it a couple of years ago. Anybody know what that means exactly? It means for the most part that I don't think there's terrible precision in the market, and trying to get too precise just comes back to bite you. So just like in general trading, instead of saying oftentimes, that's my entry and that's my stop and that's my, I kind of say, well, here's my entry stop, kind of surrounded with some gunshot instead of just a little BB gun. So the same thing really applies to what I'm about to teach tonight in a sense, because if you are just like trading the market for a long term, some people just put their money into the market. They just buy the QQQ or the SPY and that's their long-term investment. I think that's a horrible thing to do. Some people just put their money into a mutual fund, which is just basically the same because the fund is 100% as bullish on the market. Mutual funds, as you know, as I've mentioned in many other presentations, 92.5% of the mutual funds, that's a real number, that's not a made up number, appears. 92.5% of the mutual funds do not beat the market. And when the market drops, their goal is to try and lose less money than the market, and both are completely unacceptable. So I like the shotgun approach, and you will see exactly what I mean in just a couple of minutes. Spreading the risk, again, rather than trying to, put all your eggs in this one basket, it's the same thing as if, I knew a guy that his whole entire portfolio was one stock because he worked there. And he's like, well, what if something happens to the company? I mean, your whole life is depending on one thing. So, but it's the same thing with the market. I mean, you can wake up tomorrow and there's a mushroom cloud over Washington, D.C., and the stock market's cut in half in 2 days. And, what are you going to do? Even if it's only cut by 20% on day one, you're just going to sit there and stare at it because you think it's going to come back. So a lot of stuff can happen. So I think it's a lot better to have a more diversified approach. I don't like the word diversified. I hate that word actually, but a more intelligent approach. The negative to all this, I'll explain in a minute, is it takes some understanding to do this. It's not something you just, pick up a paper manual and read it in 3 minutes and understand what to do. But I want to show you exactly what I do. With the market, you're either right or wrong. But if you trade around a market bias, and I'll explain more what that means, by using a combination of market stocks, quasi-unique stocks, and fully unique stocks. Now, I made up those words, so you don't Google them. Don't go stock market, quasi-unique. You're not going to get anything because I just made these up. But what it means is that you can have stocks that if you trade them, like if you trade NVIDIA, you're just trading the market. Don't kid yourself. Sometimes it's a little stronger. The last few days it's a little weaker. Today was a little stronger, but you're just trading the market for the most part. There are stocks that you can trade, and this is really the goal of this, is that you could short the stock because you think maybe the market's at a top, and maybe the market fools you and goes higher, but guess what? Your stock goes lower. What a bonus. And if the market goes lower, your stock goes even lower. Wow, is that ever great? But a lot of those stocks that do that may only do it for a period of time. If the market really gets into a situation, like when it got super bullish over the last 2 years, or if we have a real crash, quasi-unique things also often become not so unique because eventually the market picks up on most of those things. So you can have something that's kind of unique. In other words, maybe it's holding up well while the market starts to drop, but if the market really starts to drop, it will tank as well. But there are some fully unique things. These are things that are just going to defy the market no matter what, because they're just fully unique because of some independent situation that they have. A lot of times a very unique gap will cause that. It could be because of a specific sector they're in at that moment, that the market falling or rallying, whatever, it's not including that sector. So these are the tools that you have to try and trade around a market bias using market stocks, quasi-unique and fully unique stocks. Discuss. I just discussed it. Slide. Keep up with me. Well, why am I teaching this if this is such an important, valuable lesson? Why isn't it part of the seminar program? Well, it is. It's just that here's the thing. This is just structure. I can sit here and tell you all day, well, follow the market bias, but do you know what a market bias is? And I'm not talking down to anybody or anything. I'm just saying, like DTS seminar students, at least they know what I think, how you do a market bias and what it is and how precise to be with it. But if you don't have a clue on how to read a chart or what a market bias should be, then of course this is only helpful to the extent that you can understand a market bias. And then number two, you have to know the chart patterns of all these individual stocks that you'd be trading, because without that, it again becomes useless. So what I teach in the seminar program, there's a lot of seminar program members here, is how to read those charts, how to find these stocks that we're going to be talking about. So I'm just going to talk about stocks that work. So that's why I'm teaching this concept here. So here's the concept. And we're going to talk a little bit about these first few slides here. Here's the market, all right, in a silver line fashion, right? Appears in an uptrend. So you're going along, and I'm just trying to think as maybe some of you think or have been thinking or whatever. And let me make this exemption again, as I do for every one of these long-term presentations. When I did my first podcast, yes, on the website you'll find under other stuff I do podcasts, I made a kind of exception. I picked out somebody that said, hey, you know what? If you're the type person when you were young in your 20s, you started dollar costing into the market, you've done that for 10 years, 20 years, 30 years, 40 years, and you're never going to touch the market, congratulations. That's great. I applaud that. You don't need to listen to any of this stuff. Just hang on until you retire, and that's just fantastic. The problem is that some 93-4% of the people have not done that. And you're probably one of those people, if you're listening, you could be in pretty good shape, but you're saying, hey, I'm not really on track for where I'd want to be. And the problem is some people who are seriously not on track then try to take matters in their own hands and get more aggressive with the market, which usually leads to doing even worse. So I'm talking to that 94% of the people that are a little more active. In other words, you're not planning on hanging on. This involves you and on how to do this and how to handle this. Because what you may be thinking right now is, okay, last 2 years are pretty bullish years and you got some good profits, and you may be thinking, okay, should I be hanging on? Should I be selling? What should I do? Maybe you thought this 2 years ago and you sold everything because interest rates are going up and the market put in its biggest run in 2 years, the last 2 years, and then you missed all that. So how do you handle the situation? Well, here's the problem when you're just simply in a bullish portfolio and it's maybe all market, or it's just some guy that's just duplicating the market, or it's just, you benefit from the time up, that's great. But here comes the problem. We're in this uptrend. You start to think when you get up to this lofty area, you start thinking, oh, is that the top? What do I do? And then you have this big rally, go, holy cow, maybe that is the top, right? Should I sell? Should I hang on? And of course, maybe a long time ago, you sold this. And then after this little dip, it went 52 times higher, right? And you're like, well, that's a stupid thing to do. I'm never doing that again. And then so you have a pullback and you go, okay, well, good pullback. I guess I'm glad I hung on. Should I buy some more stock? What should I do? I put questionable pullback because that is a questionable pullback to me, just even though it's a hand-drawn chart. You go, oh no, we can't make a new high. Is this the top? Am I done? What do I do? Hold it. What do you do right here in this situation? Anybody that wants to take a gander at charts, what are we doing here? What should you be doing, do you think? What would be the appropriate thing to do, assuming that you're not going to hold your long-term positions for a huge pullback, right? Now keep in mind, if you've decided you're going to hold no matter what, and you shouldn't even be here, right? Because there's nothing to discuss. But as I mentioned before, the 2001 pullback took 17 years to recover. 17 years. 17 years. And for most people listening to me, that's probably not an acceptable thing, right? It's probably not an acceptable thing. So you want to say, okay, I know how to read a chart, I know what to do, but here's the problem. This situation here, Pierce is saying, well, Pierce is calling it stage 3, etc. But here's the problem that we've been in, Pierce. For the last 12, which is now 14 years, we're going on 14 years, we make this new low, and you know what? Higher, 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 higher. Funny thing about the market, and the funny thing about if you're looking at especially daily charts and you don't step back and smooth it out with a weekly chart, you often look like you're in this thing you're calling stage three, right? And you know what? For 14 years, I've heard people tell me we're in stage three, Pierce, 12 years ago. You know, in 2010, the market tripled in value. Are you guys aware of that? The SPY tripled in value in 9 months. How many people were saying that was the top? That was 13 years ago, everybody. Right? How many people were so along the way? My point is, Pierce, you haven't maybe been around for all of this, but along the way, this happened 29 times, and every time we went higher, and every time you said sell, even under something, you were wrong, right? So you rally back up and you sold everything, right? And when are you going to go long again? Well, over the top, right? I'm going to go long over the top. And if we get to another big rally, great, but you lost a lot of money, right? You lost a lot of money from here to here, right? All that's a lot of money because that's a wide pattern always in the market and something like this. And maybe you're right, wrong, wrong again. I sold everything and I'm wrong again. But when we do finally go into a market, by the way, is the market going to crash? Quick question for everybody. And this is not an opinion statement. This will be a factual actual. Will the market crash? 100% certainty. It can do nothing but crash. It's a Ponzi scheme. I love the market, but it has to crash. It's inevitable. It's mathematical certainty. The question, of course, is when, right? That's always the age-old question. And what I am here to tell you, and I'm not saying this, most of you know me fairly well, I'm not saying this to sensationalize or whatever. I have no benefit to doing that. This crash will be a huge one. This will be devastating. It will be devastating. You don't have to be smart to figure that out. I'm not smart at all. It will be. We're unwinding an awful lot of stuff that's been going on. And once the ball starts rolling, once the snowball starts rolling downhill, it's going to be something. So my point simply is, just if you never listen to me again, is that have some kind of plan. I've sent around several emails about the LTT where, has anybody read, how many people have read Write a Number on the Bathroom Mirror? How many people does that sound familiar? Even if it's vaguely familiar and you couldn't pass a test. How many people have read that? Write a Number on the Bathroom Mirror. See, that's why I'm here doing this live, because so few people read stuff. And I get it. You get a ton of email. You got nobody's read that, huh? Write a Number on the Bathroom. Sounds familiar? Okay. The bottom line is I sent around 3 times. I sent around an email simply saying, hey, look, if you do nothing else, if you don't plan on hanging on forever, write a number on your bathroom mirror that is the maximum drawdown you want to take. Because I have seen this happen. Again, I haven't been around forever. I started in 98. I wasn't with the market before that. I don't know a lot of this stuff, but here's what I do know is that even in my time, we've had a couple of market crashes. People that don't want to hang on, they hang on. Why do they hang on? Why do people who say, like right now, sitting in this forum, they say, oh, I'm not going to hang on, but they do. Why do they hang on? There's just one simple reason. 5 words. Yeah, hoping sums it up pretty good, but yeah, they just don't have a plan. Well, they don't have a plan. They're just, okay, we're cruising along for 12 years. I'm up a lot of money. Everything's great. In it for the long run. And then all of a sudden they're down 10%, 15%, 20%. And now you start saying, oh, I'm down 20%. Well, I'm certainly not selling now. That lady on TV said this is a buyable pullback and you should never sell the market. You should always just hang on. Well, yeah, except for when they're wrong. When they're wrong, it kills you. We've talked about that before, about how the news people have their motives for what they say. Because most of the time, just say hang on, and it's not your money. They don't care. If they want ratings, that's what they want, and they're right 95% of the time. But when they are wrong, and it's very easy to tell when they're wrong, you're going to get slaughtered. So the point of all this is, okay, we're wrong again, but I'm back to the slide here. But here's the next point of all this, is when we do roll over. Mark, I agree, if you don't know what else to do. Right, yeah. I see a sad face there, which indicates to me maybe you feel bad for other people, or maybe you had a bad experience. But a lot of people have had really bad experiences, because everything you do has to be managed. It just has to be, period. Here's the other problem, is that a lot of people just say, well, okay, I know charts fairly well, and there will be a clear moment where I'm going to get out. Now, maybe to exit your longs, that's good. Maybe, I don't know. But then people start saying, well, let me get short. Here's the problem. You going to start shorting there? Are you going to start, and let's assume you're fairly aggressive so that you're going to maybe, look to short when you think the market's dropping. Are you going to start shorting there, anybody? Does that make sense? It not only does it make sense, but if you're a seminar student of mine, you could probably make the comment that that is actually illegal in DTS seminar talk, right? That's illegal to do. You can't do that. It's not allowed, right? Not allowed. Why? Because you'll be right one day, but you'll be wrong 17 times while you're waiting for this. I'm talking about a very specific thing or a very specific pattern where you don't do that. So there we have this problem that by the time you realize you're in deep, you know what, it's way too late. Right? The market had dropped. I'm making this number up because I don't remember. But there is a female financial person on TV that used to be with a different station. I won't say her name because being an Italian name and being medium height and brunette hair, you may figure out who she is. But the market, just perma bull. And I think the NASDAQ was at 5,000. I want to say it dropped all the way to 2,300, where she was still buy these pullbacks. And she doesn't know what she's saying. She just interviews people. And you know what she said when the market broke below 2,000? We have to learn how to short. She was mad. I mean, you could tell she was fuming. You can tell she lost everything probably. And she was saying, we got to learn how to short. That's when the NASDAQ went from 5,000 to 2,000. Now she wants to start shorting. But you see my point. And this is somebody on TV telling you what to do. You see my point that by the time you realize it's too late because the market is so bullish so long, you don't ever want to say, right? So the whole point of this presentation is to say, well, how do you get around this, right? How do you get around this? Believe it or not, the setup to get you to this point is, to me, the biggest battle. Just to get you to understand what the problem is the biggest battle. Teaching you what to do is going to be simple because it's theoretical. You know what I mean by theoretical? It means here's what to do, but how you do it takes some skill. More skill than even if I wanted to, I could teach you right now because it takes a long time to learn all this, but to learn how to read charts, I mean, in general. So trading around a market buy. So here's what you do, right? If you aren't all in some fund, and if you're not all in the market, if you're managing your stuff, here's how you do this. When you have these, even when you're in an uptrend, right? You want to be bullish in an uptrend, right? But what you do is when you come to these lows, you kind of buy more things, right? Just theoretically, or don't ask me how much or when or where, you just buy more things. But you buy stocks. You buy stocks that have shown unusually bullish patterns during this market correction, whatever it is. And then here's the other thing though. When you rally, and see this green, this means your portfolio. Green, red, really bullish, maybe you got a couple shorts, whatever. And then when you rally, guess what you do? What do you do when you, and again, you don't have to be calling a market top. You don't have to be saying I'm shorting. You don't have to say I know this is, but when you just rally a whole bunch and you're uncomfortable, what do, everybody? Sell some stuff. Sell a third of a great position. Maybe sell a third of something that didn't go that great that maybe you're still hoping to go well, right? And you know what else you maybe do? You factor in a few unique shorts. So you go up here and the market hits this crazy top, and you know what you find? You find the right pattern. You find a stock that when the market did this, the stock did this. You follow what I'm saying? That's what you look for. That's a quasi-unique stock. And you throw that in the mix, right? So if this for some reason turns out to be the market top, guess what? You got a couple shorts for that first big jerk down, which is hugely helpful if you do it right. And what's the other huge benefit of doing things this way? By using a quasi-unique stock to maybe add in some short when you're at a market, how do I phrase this? When you're at a market kind of accelerated short-term top, meaning maybe you're just pulling back for 3 days, 3 weeks, whatever it is. What's the other huge benefit of doing it this way? By having a unique stock short. The huge advantage is, you do that like right here, right? The huge advantage is that even if you're kind of wrong, that the market really didn't have much of a correction, and the market goes higher, maybe your short still works because you picked the right stock. Is it possible to do that? Anybody who gets the long-term trader, is it possible to do that? Yeah, right, Eric, we've been doing it almost flawlessly, right? Almost flawlessly. That's the point of this. So you just kind of keep doing that. And then of course you use your chart reading skill to say, hey, boy, that's really a big rally. I'm not that good with charts, but maybe in my mind, that's maybe the top for a while. And here's a famous thing I say a lot for those of you who subscribe to stuff, and I'm sure some of you have heard this comment, is that when you get to a certain area in the market in a long-term pattern, you have to acknowledge that any mid-term top may become a long-term top, right? In other words, you could look back. What if the market fell 50% from here, right? You could look back and say, well, gee, that was just a little midterm top, but you know what? That was it, man. That was it. And at some point, any one of these could be it. So as you see tops, you start to say, okay, that's certainly kind of a short-term top, but you know what? I don't know. Maybe that's a long-term top. So maybe you start skewing yourself a little bit more to saying, hey, let's get a little more short up here. And again, unique short. So maybe even if we go higher, still making money. Going into now we dropped for the last 2 weeks, but going into that market rally, the shorts I had all dropped. I'm going to say all. Don't hold me to this, to the letter, but I mean, just generally speaking, the shorts I had did not hurt me at all. I may have taken one that stopped. I don't remember exactly, but this concept works incredibly well if you know what stocks to pick exactly. So then we have this question of pullback, and what do you do? Well, you maybe take, if you shorted unique stocks here and you were right about the market, guess what? Your shorts are probably doing really well. And you get back down to here, and now you got to say, well, you know what? We're still in an uptrend, and we're still bullish, so you know what I better do? I better cover some of that short stuff, right? And now you're in a situation where you could be break even on your shorts. So in other words, even if you go screaming higher, you had that kind of, I'm going to call it protection, is maybe not the right word, but you had those shorts in there to drop, but yet you're not hurt even if the market goes higher. And if you do it right, even with the market going higher, your shorts may still drop. So we have this question of pullback, and then we go up to here. We can't make a new high, so what do? Right? You go back and say, all right, give me some more unique shorts. Let me sell a few of the longs. Maybe the longs you're selling, by the way, are from down here. Maybe you got some longs down here. They didn't do all that well initially, but then when the market finally got up here, you finally said, hey, you know what? This one's been lagging the market a little bit, but it's worth taking some profit, and I'm going to take some of the profit there. So you sell some more longs, take some more shorts, et cetera, et cetera, et cetera, et cetera. Does this make sense, everybody? Structurally, theoretically. I know that this is only 5% of the battle, because the battle is, when is the right time to do this in the market, and what do you mean unique stock short, and what does that pattern look like? Well, that's what you have to learn. I'm sorry, but that's the whole point of understanding charts. How long does it take to teach? Well, that's what my whole seminar program does. I'm not here to sell them. I'm just saying, hey, that's what you have to go through to learn to understand how to read charts properly. And of course, the goal is that when you get here, guess what? When you get here, you're skewed largely short and maybe unique long. And if you're unique long, maybe they're not even losing money, maybe they're making a little money, and it gives you that time. The nice thing about unique long is that they're the last ones to drop. So maybe you can look around and say, okay, boy, now we're definitely in hot water, and you put in some tighter stops on the shorts, and you take some profit on the longs now that we're falling. So you take some tighter stops, you make some small profit, you break even, you take a small loss. Maybe you take some losses, obviously, but this whole process works incredibly well. Now, I did a presentation a couple years ago where I really outlined this with my trades in the long-term trader, and I got real specific about it. I think I lost everybody. Somebody who's here with us today did the wonderful gesture about a month or two ago, sending me the long-term trader trades compared to a chart, and they did a really full-blown, like I should probably do, except they probably took like 2 days to do it. And it was much appreciated, but they were basically showing what I always talk about with this, because if you get the long-term trader, you hear more about this, but just showing me that, hey, you know what, here's what we've been doing long-term trader, and we're just following the market almost perfectly. We went pretty short up here, we went pretty long down here. Now, another question you may be saying is, Paul, long-term, but it sounds like you're buying and selling every few weeks. We are. The long-term trader is actually called long-term midterm trader. And when you're really talking long-term, you're talking about 2011 till 2021, 22. That's the 10-year move where you're really, really long term. Right now, we're in a situation where I don't think anything is going to be held more than 6 to 9 months because the upside is probably somewhat limited. And if you go into a bear market, things drop very quickly. Usually a 9-month bear market is all there is. So we're probably a ways away from holding for months or years. So this process is still what you do. It just may be in a different environment. If you go back to 2010, maybe things are running up for 6 months before you sell something and look at some shorts or whatever it is. Right now we're doing it. Well, you can see on the chart pattern here, right? This is a weekly chart. So there's 4 weeks, 4 weeks. So it's like every 4 weeks or so, things are kind of being adjusted. How's that? So this is just rough, but you can see basically right, I just started back in here at the last quarter of last year. Right in there, it's like 80% long, whatever it was. Flip up to there. By that time, we had flipped to 80% short, or maybe it was almost all short. At one point, we were almost down to zero in positions because it just took profit and everything. And then, so if you start adding shorts, at one point it was virtually all short up in here. Flip to some more long, flip to more short. So you can see it's exactly what I do. And this is the actual trades I've been doing. That's a graphic representation approximating the longs versus shorts. So you can see exactly what I'm doing. And that benefit I discuss has really been phenomenal because basically speaking, of course there's stop outs and stuff, but the shorts basically on balance have worked even during the market rally and to some degree the reverse. Like for example, Nike. I've had Nike long and I think it hit the target when we started pulling back, but it's held in there. It's held in there so well that the raise stop on Nike is still above where I took target one. Despite this huge drop, it still got it. So I got the back 2/3 of Nike. And despite this hard 2-week drop, Nike is holding a nice uptrend and the stop loss on it is above target one. I think I'm right in saying it, yeah. So that's exactly what we're trying to do by doing this. Time out for any questions or comments or anything that you have. I cannot explain how valuable this is. Some of you don't care, and some of you, like I said, well, some of you really don't care aren't here. But structurally, to understand this, to me, it's how you do things. It's not an actively managed approach. I refer to buy and hold as buy, hold, and pray. Excited figure way to say. Yeah, that's what it is. I mean, I've been preaching since I started trading. I mean, the buy and hold concept is really dead. Well, let's rephrase it. If you have a 30-year outlook and you diversify to some degree, you're fine. You're going to have stocks that go to zero. But yeah, and you know what? Another great, if you want more follow-up on that, go back to last month's presentation where I said just buy Apple, which actually had a little, well, it's sarcastic and it's not sarcastic. If you bought Apple, you did great. But go back and watch just buy Apple. Actually, market discusses exactly what you're saying, that even if you think, oh, just buy Apple, it's all you do, you can't do it. It doesn't work. I mean, it does if you win the lottery, but if you don't win the lottery. Thanks for remembering me tied up. Okay, all right. Hi, Anise. The session is so simple but profound with clarity. Well, thank you. Thank you. Are there any more questions about this? Because that's all I have as far as the educational thing. I took up my whole half hour just doing this. Because I'm going to flip a switch here. Oh, yeah, I know, Art. I know. I tell those stories all the time. You should tell the real story. You know what the real story is? The one I use all the time, MicroStrategies. Now it's undergone a lot of reverse stock splits, but I still know the numbers are. It went from $323 to, are you ready for this? Anybody know the number? 47 cents. I know I often make fun that the person who bought it at 323 is probably the same person who sold it at 47 cents. That's for real. That's for real. Now you'd have to do a lot of math because if you go look at it today, it's done reverse splits and it's all over the place. But hey, I'll give you another quick story. I'm in a hurry to go and I can chop this up if I want to, but back in 2001, where I had the mindset that the NASDAQ was going to 2,000. It actually went to 1,600. There was a guy who was running a trading room back then. There was a guy back then, and Cisco had dropped from 85 to 60, and he said, I'm buying a ton of Cisco. Now, I had spent every day in the room saying, folks, this is not a viable pullback. This is the beginning of a move lower. Every rally is shortable. We don't buy market stocks long. And he said, I'm getting Cisco here at 60. I said, okay, whatever. A few weeks later, I asked him how it was because I was, I wanted to hear. Cisco's down to 52. Well, you know what, Paul? I'm buying more Cisco. Really? Okay. I'm like, what do you do if it drops to 40? I'll buy more Cisco. Anybody know the number where Cisco ended up at? Yeah, yeah, it hit 8. No, it hit 8. It hit 8. So somewhere after 35, when he stated I'm buying more Cisco, I didn't hear from him again. Do you know why? He's broke. He's broke. Heard from another guy. What's the best way to build an account? Day trading or swing trading? Well, you want to do both in these. It depends. To build a long-term account, first of all, I don't suggest swing trading at all. If I have the free stuff page open, I do. Here's a video for you to watch. If you're with the market as a day trader, I think that swing trading is okay if you're taking intraday entries. If you're working a job, I think swing trading is a time frame that is so difficult you shouldn't even do it. But a longer term approach where you're not trying to take 3-day profits on something, I think is what you want to do to build an account. Now, day trading is for income more or less, but you got to be available to be sitting there, of course. Day trading will produce a high return generally, of course, but you're working, it's a job. Passive investing, what am I doing here? Passive investing, you don't have to be there. You just have to put in a few minutes a week. All right, so that was the story about Cisco. So we're done. Any more questions about this? Because I'm going to switch modes here and go to talk about the long-term trader. Now, I have a lot of people that wanted to be here for this, so I'm going to discuss the long-term trader. If you have any other questions, ask them now or wait till I'm done so these people can get what they want to do. And apparently a lot of people are confused by this. So at DTS, I have a seminar program, you know that. At DTS, I run a trading room that's a paid for subscription that you join if you want to day trade the first hour or two of the day, usually for the most part. And then for longer term traders, there's a letter. It's called the DTS Long-Term Trader. You get by email, you get a text message to let you know that you have an email, and I'll show you what you do. Now, a lot of people are confused by several of these things. Number one, it's an email letter, but it is for you to manage your own accounts. In other words, you have your account. Nobody sees your account. You got to get some money from somebody from wherever you have right now. And then you simply do the trades that are suggested. You enter the trades, but if you want to follow the recommendations of the long-term trader, you can follow the 100%. There's like a little rule book that comes along, what to do if you're told to enter over a certain number, but in the morning, what if the stock gaps over that number? Since I can't be, emailing every 3 minutes of the day as the stock is changing like I would be when we're day trading, there have to be some rules that accompany it that come into play sometimes. So you're given a position, you manage your own account, you handle all the buying and selling, it's all you, it's all your money, nobody knows how you're doing, you just have a letter to refer to, all right? All you have to figure out is your risk amount that you want to put into every trade. What is critical, especially the way that I trade, and I say trade for long-term as well, long-term trading investing, is that you maintain a fixed risk amount. In other words, when you have a position sent to you, you will look at an example in a minute, it'll have an entry and a stop, and let's say that's a $2 amount, and let's say you're risking $1,000 per trade. That means you take 500 shares, period. Every trade has to be equalized to that extent because, as I always say, stop outs are cheap. Stop outs, they cost you one risk unit, whatever you're risking, $100, 200, 500, 1,000, whatever it is. And the winners tend to be much more. Did I cover everything on there? So that's the first thing that people seem to be a little confused about. It's nobody's taking your money. You're just subscribing to a service that sends you trades. It's an investment letter for midterm and long-term traders. This may include day traders who also manage long-term accounts, blah, blah, blah. You trade your account, but you get the long-term trades. So this is what it looks like, just a snippet of it. You get a new position. It comes in your email. You get a text saying, ding, 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 you have a new position in your email. And it'll be a very clear thing. It's saying, here's the stock, Nike, there's the stock, the next earnings are coming up, blah, blah, blah. I will never take out a position in front of earnings as a gamble to trade earnings. I'll never do that. However, the goal is you do want to hold through earnings if you can. And our goal is to have a 5% equity at least before we go. That's the general rule. I may change that with an email, but otherwise that's the general rule. It gives you a clear long over, stop under, full risk. Sometimes they may do a partial risk, don't do that often. And then it gives a target 1, and it says for 1/3. And I put the DTS strategy here also. That's probably most understandable by some of our students, but it gives you an idea of what I'm looking at. If you care, you don't have to care. This is not for seminar students. There are many seminar students that subscribe to this, but this is more for somebody who doesn't want to learn. Just says, hey, just give me the trades, I'll learn later or I'll never learn. So that's what it looks like when you get a letter sent you with a position. Some comments in general. There are not tons of positions. I know a service, oh, by the way, I mentioned this a year ago and it's back. There is a larger, much larger company. I'm puny. I'm not even on the scale. There's a mid-sized company out there that probably wouldn't know the name, but you might, that is copying my trades. So I have a spy that subscribes to this letter because this happened a year ago. And just looking at probability and statistics, there's zero chance that that's not true because there's no way out of all the stocks. And they generally like my shorts, but it's rather amazing. And I've decided I don't care. I mean, okay. I mean, somebody should be paying me a lot more money, but you want to tag on to my trades? Can't hurt, especially if you have enough subscribers. Maybe you'll help us a little bit. But anyways, I always think that's funny. I mentioned that a year or two ago when it happened, and then I didn't notice, and the person who identified this for me was showing me again that it's an issue again. Anyways, there are not a ton of positions. I know sometimes there's swing letters and stuff. They have you in 40 or 50 things. I think that's completely insane. I'm just going to say that's wrong. That's just crazy. The way that it's phrased, and again, when you sign up or if you want me to send it to you, there's a little description about some of the general outlines of the long-term trader. Generally, I look at 6 positions as being kind of maxed out. Now, I never want to be in more than 3 positions that are full risk. So it's kind of you take 1, take 2, take 3. If there's some built-up profit already, that's great. But if we take 3 positions, kind of want to let those season, get the stops up, hit some targets. In other words, I never want to be in a position where all of a sudden the market takes a turn and boom, 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 I'm down 4 or 5 risk units. You know, that's unacceptable to me. So you want to kind of build into things. And in the future, when we have a real long-term situation, like I'm saying, okay, these things are good for years, we'll have more than 6 at some point, you know. But what would happen then is my other philosophy in doing this is that I like to take a third target at a very healthy target. It's usually 3 to 4 to 5 risk units. And if you know what that means, it means on a risk-reward basis. The first target is a reward to risk of 3, 4, 5 typically in that area somewhere. And then the second target I like to be huge based on the charts. The third target is kind of theoretically hold forever. So the idea would be, now hold forever today isn't really forever. But if you go back to like, let's say we hit a market bottom. I'm trying to draw here. Let's say we hit a market bottom and we're looking to hold for 10 years again, right? My idea is you take a trade, you sell a third. You take 2 trades, sell a third, boom, boom, boom. Take a couple more trades, boom. And the idea is that you're kind of clipping out thirds so that you're just kind of safe with everything. Second thirds, you go for really nice targets. And then what ends up you doing, you end up accumulating those thirds. You just hold on to them forever. You just accumulate them. So that is because most people at the end of a bull market ain't got nothing because they sold it all if they're too active, if they're too hyperactive. So these are the things you just hang on to. They'd be the safe last thirds from all the positions, and that's the idea. Now, that's not really happening now because I look at things being more of a midterm basis. Does all that make sense so far? Anybody who's listening who cares to listen? A lot of information out there. Okay. So right now, the third is taken when I feel it's appropriate. But for the most part, the last couple of years, my Sharpe ratio has been 4. It was 4, it was 3.8. Last year, it was a little confusing because of a leverage thing that I had, but it was a little less than that. And this year, I'm just kind of doing the stats for this year. It's less than that right now. I think it's just under 3 right now. But the reward to risk that I go for is bigger for long term. So generally not more than 3 units. What's 3 risk units at once? Trades are a mix of market stocks, quasi-market stocks, and unique stocks, all depending upon market. Now, earlier tonight I called these quasi-unique stocks. It's the same thing. If you're right, half full, half empty, quasi-market, quasi-unique, whatever you want to call it, but you get the idea. Which means that LTT is designed to perform as well or better in bear markets as in bull markets. How important is that? Well, you start thinking about where we are right now, it's hugely important. You start looking at portfolios and mutual funds that tell you, well, if the market drops, we'll try to not lose as much as the market does. That's crap. I would run from. Who wants to lose money? Does anybody here want to lose money? Does anybody here like hearing that, oh, when the market drops, we'll try to lose less than the market drops? It sounds like something that the financial people say on TV. So it's hugely important. And actually, typically, the LTT is done even better in bearish environment. So remember the end of 21 and going into 22, that was that huge bear market slide that we had. And I just put that on there to show you that I'm not just, making stuff up, of course. I've done the long-term trader ever since the second year DTS Open, and at the prior company I did one the whole time there as well. When did that slide start? It started, I'm looking at a chart here real quick. Yeah, so that started, right the third quarter of 21 and lasted until the third quarter of 22. So during that crash, the COVID crash, that's what we did. More comments? Now, suggestions for use. This is something I put in the last email because a lot of people saw this say, hey, wow, what a great idea. A lot of people may be stumped because you're saying, all right, I got my money with this guy. The guy, whether it's a fund or whether it's, somebody's managing your money or whatever. And he could be, and by the way, let me take a moment here as well to say, because sometimes people get confused when I'm talking about funds and when I talk about financial planners. Financial planners are great people. Never a bad word to say about a financial planner. Financial planner sits down with you and simply says, hey, here's what you got. You got this much money right here, and you're making this much, and you're this many years from retirement. So we're going to take this much of your money and put it in fixed assets. We're going to buy bonds for 4%, whatever it is. And we're going to take this much of your money and we're going to put it in something in the market. And we're going to take this much of your money and put it in something really aggressive that you may lose. And as you get older, the market becomes riskier to be in. Well, the only problem I have is that the market never has to be risky. You can see from what I just said, if you do it right, the market is never risky. You make money when the market drops. It's never risky. But for a financial planner, that's the only little asterisk that you got to put by their name, is they're going to just say the market is risky. So if you were to take that market money from your financial planner guy and say, hey, you do everything else, but give me, and if you're not comfortable with that, which maybe you shouldn't be, take some of it, take half, take a third. Maybe your significant other says, you're not taking $500,000 and managing it, especially that stupid guy you listened to on that webinar. He doesn't know what he's doing. You're going to lose all the money. Well, take 100,000 out of 5, or whatever the numbers are for you, whatever they are, and do it for 6 months and see. And if you can beat that guy, take another 100 the next 6 months, right? There's a method to do this where you're not scared and your significant other isn't beating you over the head, right? Makes sense? The other thing I get confused in people, when I said that the LTT costs 3% on a $100,000 account, to confuse people. And I probably phrased it the wrong way. All I'm saying is the price, you should really do it for a year. There is a monthly price, but it's $27.77 for the year. And all I was saying is that on a $100,000 account, that's 2.7%. So if the LTT beats what you're doing by 5%, well, just from a numbers point of view, it makes sense to do it because you're spending 2.7. And if you have $1 million account, well, it's 0.27 because it's a fixed cost. You're paying one time for the LTT. The more money you have, naturally, the less it is as a percentage. But it's not a percentage. Nobody's knocking on your door saying, how much money do you have? Give me a percentage. Nobody's saying that. There's one price for the LTT. And I was just pointing out that it can be very, very cheap compared to not having it if you're not making good returns with what you're doing. Blah. What about if you have $50,000? Well, then it's like 5.5%. Is that worth it to you? Well, even if it is based on the numbers I've been doing, but even if you had less than that, maybe the learning experience is worth it, even if you just kind of break even, because on a smaller account it costs more, not more dollars, but more percentage-wise. I'm not sure I'm clearing things up or if I'm making it more complicated. Am I clearing things up or am I making it worse? Good, okay. And if you're managing your own but want a little help, use the LTT to make sure you don't compare results. So here's the other warning I have for everybody, is that if you're going to do this and you're going to manage your own stuff, and maybe you are already, and you'd like to use the LTT to supplement your thoughts, or maybe you're going to take some money from your guy and start managing some or all of your money, and you're going to use the LTT to do that. Well, maybe you're going to say, hey, I'm going to see if I can beat that guy, but let me also see if I can beat Paul. Maybe I'm going to take some of my own trades. Well, that's fine. It's your account. You can do whatever you want. I just ask you to do one thing. What would that one thing be? If you're going to do some of your own stuff in there, naturally you have a right to do whatever you want. It's the same answer to almost everything in trading and results. Yeah, exactly. Track it. Just prove it's worthwhile for what you're doing, right? People sometimes also ask, there's a long set of rules for the LTT, and I put out a video with it that simply says, hey, look, you don't have to follow these rules at all if you don't want to. I mean, it's your money. Do what you want. But the rules are two things. Number one, The rules are the synthesis of many, many, many years of experience by me. And I've had people tell me the rules are worth the price of the year of the subscription, just the rules. Now, naturally, if something happens in the morning, right, I'm in a long position and it gaps down or it gaps to my stop or whatever it is, naturally, I'm going to make decisions about what to do. Now, what I tried to do is incorporate those into rules, and those rules are out there in the LTT, exactly how to handle it. And over X number of trades, they work really, really well. For any one trade, maybe you'd look at it and say, well, I don't want to handle it that way. This is really a bearish gap, and I want to get out immediately. Okay, that's up to you to do. But again, I just suggest that you kind of track any management variances you do on your own to see if you're helping yourself or hurting yourself. That's all it is. And it's easy for you to track. Well, actually, you'll kind of be self-tracking because you will produce X percent and the LTT will be showing you what it's doing and you will know. Any questions on any of this? Am I near the end yet, for crying out loud? And that's it. So if anybody who had those questions, if I didn't answer them for you, please let me know. If anyone else has questions, let me know. I'm done yakking. There is a page that is super detailed about this. So if you want to, I tried to hit the highlights, but there is the detail page that describes the long-term trader. And if you want to either sign up or see pricing, it's there. The annual LTT is heavily discounted compared to the monthly because I really suggest you do annually because it's hard to judge a 1 month. Anything else? Any questions? Any comments? So the trades are taken based on text communicator trades copy with technology. No, neither. You get an email, and I showed it to you up here. You get an email that, it's a longer email, but that's the guts of the email. You get an email that looks like that. You get a text that says, hey, you have an email, just because, at least for me, I see every text I get immediately. My personal email, I hardly check. So, and I don't want to get in the situation where perhaps the email and text differ. So I think in today's world, everybody can access their email if they know to. So you get a text that says, dear LTT subscriber, you have a new position in your email, or you have a general update in your email. And if it's a new position, it's maybe it'll say urgent. If it's something that during the day and I'm kind of like, oh, this thing may trigger really soon, I'll put urgent on it, meaning, get on your phone or get whatever you're doing to get it. And then you read what it says, and then you trade it however you trade it. Get on your phone and enter, a buy order, a stop limit order, a stop market order, call your broker, whatever you do. Does that make sense, Denise? All right. Anything else, anybody? Well, thank you, Art. And that's a compliment coming from Art because he normally says everything stinks that I do. So that's really, no, he doesn't. I'm just kidding. You can join this anytime you can start. Anytime. You just sign up, you pay, you'll be started that next day. Yeah, you can start any time of the month. It doesn't matter. I usually will, catch you up with the last couple of issues that are relevant. Of course, the ones before that are not relevant probably, but thanks everybody. I'll see you all the next time I see you. Have a great night. And if you're not in the trading room, have a great weekend. If you're in the trading room, I'll see you in the morning.